Most people think financial freedom requires millions, but the truth is, it starts with just 100 euros. That was the first milestone that changed everything for me. And today, I'm going to show you exactly how to reach it using income-producing ETFs. We're running a hands-on experiment. I'm virtually investing 25,000 euros into a wide range of different funds, not some trash ETFs, but quality picks I'd actually consider for my own portfolio. Is 25,000 euros enough to hit that 100 euro a month milestone? That's 1,200 euros a year, and the results might surprise you. And more importantly, what happens to that cash flow in 10, 20, or 30 years if you let the compounding snowball do the work? We're going through each fund step by step, from the lowest yields to the highest, to see how they stack up against each other. But as always, this is not financial advice, just my own opinions and experiences. First up is the SPDR S&P US Dividend Aristocrats ETF. This fund is all about reliability, targeting U.S. companies that have increased their payouts for at least 20 consecutive years, a strategy I personally love. The payouts here are incredibly stable, but there's a catch. The average dividend yield over the last 5 years is quite low, at just 2.3%. On the bright side, those dividends grow by an impressive 7% per year on average. Let us invest 25,000 euros here and check the numbers. With such a low starting yield, you'd have to wait and reinvest your dividends for 10 years just to hit that 100 euro monthly average. However, with that strong dividend growth, patient investors will see their cash flow really start to snowball the longer they hold. Still, most dividend investors prefer a higher starting yield, which brings us to our second option. Next up is a crowd favorite, the Vanguard FTSE All-World High Dividend Yield ETF. In my opinion, this is the ultimate set-and-forget investment because it spreads your money across more than 2,000 companies globally. However, there is no strict quality filter here. If a company pays a decent dividend, it's likely in the mix. While that massive diversification makes the payouts very reliable, with an average 5-year yield of 3.5%, there's a trade-off. Dividend growth is slow, averaging just 2.7% per year. If we put our 25,000 euros to work here, the income is stable, but it doesn't move much. To reach that 1,200 euro a year goal, you'd need to reinvest for about 7 years. And one thing to keep in mind, thanks to inflation, 100 euros 7 years from now won't have the same purchasing power as it does today. Moving on to the LDGE Global Quality Dividends ETF. This fund is a newcomer, but it's already gained significant traction because it targets quality companies globally and pays out income every single month. Since it's so new, the actual history is short, but the projected yield sits around 3.85%. To stay conservative, we'll use 3.7% for our calculation. As for dividend growth, we'll assume a solid 7% annual rate, a realistic estimate given its focus on quality. Investing 25,000 euros here shows a great trend. While it won't generate 100 euros a month immediately, that quality growth means the income snowballs much faster than with the Vanguard ETF we looked at earlier. If you can be patient and reinvest for just a few years, the results are incredibly rewarding. Our next candidate is the Invesco S&P 500 High Dividend Low Volatility ETF. This is an interesting fund that I feel doesn't get enough attention. It selects the highest yield stocks from the S&P 500 while specifically aiming for lower price swings. What I like most about this ETF is the stability of its payouts. The 5-year average dividend yield is a solid 3.9%, and since its launch, the fund has delivered a respectable average dividend growth of 4.3% per year. Let's plug in our 25,000 euros and check the results. Honestly, this looks very promising. To hit our goal of 100 euros a month, you would only need to wait 4 to 6 years, depending on whether you reinvest your dividends or take them as cash. Next up is the SPDR S&P Global Dividend Aristocrats ETF. This fund invests worldwide in stable companies that haven't cut their dividends for at least 10 consecutive years. The consistency of these payouts is excellent, which is exactly what I look for in an income investment. The average dividend yield over the last 5 years is 4.2%, and since its launch, dividends have grown by a respectable 3.9% per year. Let's put our 25,000 euros to work and see the numbers. With a yield above 4%, we're finally reaching a point where we hit our target almost immediately. In fact, you'd only need to let this investment grow for about 3 years to comfortably reach that 100 euro a month goal. Now, let's look at a lesser-known ETF with incredible potential. The LDGE Europe ex-UK Quality Dividends Equal Weight ETF. It focuses on high-quality dividend companies across Europe, excluding the UK, and while it's only been around for a few years, its performance so far is highly impressive. What stands out is that its payouts have been both stable and steadily rising, a feat very few dividend ETFs managed to achieve over the last 3 to 4 years. The average yield sits at a strong 4.5%. Like the other L&G fund we discussed, this ETF targets companies with rapid dividend growth. In fact, since its launch, dividend growth has been over 10% per year, which is absolutely wild. To stay realistic, I doubt any ETF can sustain a 10% growth rate forever. To be safe, we'll use a conservative 7% for our calculation. Here is how the cash flow looks. With our initial 25,000 euro investment, we barely miss the 1,200 euro annual target in year 1. But the long-term projection is phenomenal. Now, I'll be honest, these numbers look almost too good to be true, so it's important to stay grounded. For this ETF to actually deliver that, it would need to maintain this stellar performance for decades, a massive challenge for any fund. Next, let's look at the second most popular dividend ETF in Europe, the VanEck Morningstar Developed Markets Dividend Leaders ETF. This fund holds 100 high-quality dividend stocks from across the developed world and has a proven track record of impressive returns. What makes it compelling is the balance. It delivers consistent dividend income alongside robust capital appreciation. The 5-year average yield is an impressive 4.8%, and since its inception, VanEck has maintained a solid annual dividend growth rate of 5.4%. While past performance is never a guarantee, we'll project these trends forward for our experiment. With this fund, you would actually hit that 1,200 euro annual target within the very first year. And if you allow those dividends to compound, the long-term cash flow potential is truly outstanding. For a more targeted European strategy, we have to look at the Franklin European Quality Dividend ETF. This fund has demonstrated strong price appreciation recently, complemented by a very attractive yield. Its 5-year average yield stands at a solid 5%. However, the dividend growth has been more modest, averaging just 2.8% annually since its inception. If we allocate our 25,000 euros here, the ETF comfortably generates over €100 per month right from the start. But there's a catch. If your goal is long-term income expansion, reinvesting those dividends will be essential, as that lower organic growth rate won't do much of the heavy lifting on its own. Our next fund also focuses on Europe, specifically the Eurozone, the Invesco STOXX High Dividend, Low Volatility ETF. It's worth noting that this fund is heavily weighted toward the financial sector, which makes up about 50% of the portfolio. While that's a concentrated bet, it's also the engine behind its performance, making this a true powerhouse with a staggering 5-year average yield of 5.9%. Even better, the annual dividend growth sits at a strong 5.8%, more than double what the Franklin ETF offers. Let's invest our €25,000 and watch the magic happen. With a yield this high, you instantly collect over €1,200 in year one, and the projected growth is incredible. In fact, according to the dividend calculator, reinvesting your payouts for 30 years would result in over €122,000 in annual dividends. But why is that number so high? It comes down to our mathematical assumptions. We assumed the high yield and dividend growth stay constant, while the share price only grows at 2% per year. This means that when you reinvest, you're accumulating new shares at a rapid pace, which supercharges the compounding effect. In reality, these numbers are extremely optimistic, and it's likely that the yield or growth rate will cool down eventually. Here is another European ETF that I really like, the WisdomTree Europe High Dividend ETF. Unlike the Invesco fund, this one invests across the entire European continent, offering much better diversification. But when it comes to the numbers, it matches the Invesco ETF perfectly. It features a 5.9% 5-year average yield and an identical 5.8% annual dividend growth since its launch. These figures are so impressive they almost seem too good to be true, which naturally raises the question of how long they can be sustained. But if we run the math with these numbers, we get the exact same powerful compounding results. If you are enjoying this video, hitting the like button and subscribing really helps the channel. Thank you. If you're hunting for even higher yields, we have to look at a completely different category: covered call ETFs. I could see myself adding these to my portfolio someday. There is the JP Morgan Global Equity Premium Income Active ETF, or the European version of it, and the US Tech version. Another interesting option is the iShares World Equity High Income Active ETF. In fact, I already hold a small portion of that iShares ETF in my own portfolio. These funds offer massive yields, often reaching 8% or more per year. But a yield that high always comes with a catch. Covered call ETFs generate these payouts by selling call options, which effectively trades your upside potential during bull markets for immediate cash flow. If the market rockets upward, you won't capture most of those gains. Yet if the market crashes, you still bear the full downward risk. Because of this, you have to handle these ETFs with care. You shouldn't expect much in terms of payout growth. We'll assume a modest 2% annual increase, hoping managers adjust their option strategies for inflation. For capital growth, we should be happy if the share price grows at all over the long term. Let us be conservative and assume a tiny 1% annual growth rate. However, there is a bright side to this. Reinvesting these high yields lets you accumulate more shares much faster since the price isn't moving up quickly. Under these assumptions, your cash flow starts at nearly €170 a month, which is fantastic. If you reinvest, that income can skyrocket over time. Just remember, high-yield ETFs carry real risks, including the potential loss of principal. Ultimately, you have to decide which strategy fits your own risk tolerance. Those are all the ETFs I wanted to share with you today. Now, I want to hear from you. Do you own any of these in your portfolio, or are there others on your watch list? Let me know in the comments below. If you found this breakdown helpful, don't forget to like the video and subscribe for more dividend content. Thanks for watching, and I'll see you in the next one.